Maximizing Price Stability in a Monetary Economy by Warren Mosler and Damiano Silipo. Section 7a, Fiscal Balance. Fiscal balance is ultimately market determined. The public debt is the accounting record of the net financial assets held by the non-government sectors. It is a total of the euro spent by the national governments that have not yet been used to pay taxes, and which will remain outstanding as cash as euro balances in reserve accounts in the ECB system, and as euro securities account balances in the ECB system until they are used to pay taxes. That is, when a government spends a euro, it is either used to pay taxes, in which case it is removed from the economy, or it is not used to pay taxes, and instead held as savings. When the public deficit is too small to accommodate the private sector's saving desires, market forces, perceived shortages of income required to be able to meet savings desires, depress spending and employment, which reduces tax revenues and increases state transfer payments, thereby increasing the public sector deficit. These market forces continue to point where the public sector debt is, by identity, equal to desired net savings of euro-denominated financial assets. With the proposed employed transitional labor buffer stock, the same market forces are at work to determine the level of public sector debt. When desired savings exceeds the size of the public debt, market forces work to reduce spending, sales, output, and private sector employment, which reduces tax revenues and, in this case, increases the number of transitional job employees, and at the same time, the total wage bill for the workers in the transitional job. As is currently the case, the public sector deficit and debt would continue to be set by market forces that equate savings desires with available savings.